The internal rate of return method, like the NPV method, is a discounted cash flow technique because it recognizes the time value of money. The internal rate of return method differs from the net present value method in that it finds the interest yield of the potential investment. The IRR is the interest rate that will cause the present value of the proposed capital expenditure to equal the present value of the expected net cash flows. It's the interest rate that causes the cost of the investment to equal the PV of the net cash flows. We can determine the internal rate of return by using a financial calculator, an electronic spreadsheet, or by trial and error. Let's assume that Stewart Shipping Company is considering the purchase of a new front-end loader at a cost of $244,371. Net annual cash flows from this loader are estimated to be $100,000 a year for the next 3 years. To determine the internal rate of return, the company needs to find the discount rate that results in a net present value of 0. Stewart Shipping has a positive net present value of $4,315 at 10%, and at a rate of 12%, it has a negative present value of $4,188. At 11%, the net present value is 0. Therefore, 11% is the internal rate of return for this investment. An easier approach to solving for the internal rate of return can be used if the net annual cash flows are equal. We can find the internal rate of return using the capital investment and the net cash flows. Applying this formula to the Stewart Shipping example, we obtain an internal rate of return factor of 2.44371. We then look up the factor in Table 4 of Appendix G in the 3 payment row and find it under 11%. Recognize that if the cash flows are uneven, then a trial and error approach or a financial calculator or computerized spreadsheet must be used. Once a manager knows the internal rate of return, they compare it to the company's required rate of return, or the discount rate. The Irr Decision Rule is as follows. Accept the project when the internal rate of return is equal to or greater than the required rate of return. Reject the project when the internal rate of return is less than the required rate of return. The internal rate of return method is widely used in practice, largely because most managers find the internal rate of return easy to interpret. This slide compares the two discounted cash flow methods, net present value and internal rate of return. When properly used, either method will provide management with relevant quantitative data for making capital budgeting decisions. The solutions to this exercise will be provided in the next video.